Welcome to TMS Insights. Jeremy and Ben bring you the first of two updates in the February reporting season, which overall, Ben, started pretty well. We're about halfway through the market cap as we speak today, and 40% have beaten and 31% have missed. So they're looking all right, and justified the good rally in the market in January.
Yeah, absolutely. It's been, as we always see, there's been some real winners and some real losers. But I would say generally we've been really happy with pretty much every result that we've seen from the companies that clients hold. I don't think there's been one that we've sort of looked at and thought not great or not happy. So far so good. Probably pretty reflective of how the market generally is travelling, and no doubt CEOs have been a bit more reluctant to give guidance again. We're going back into that a bit cautious.
And people will remember we did say we expected good numbers in this reporting season overall, but we did worry about later in the year as a consumer might have pulled back, and maybe even though they're not necessarily widely held stocks, to talk about something like Super Cheap Auto and JB Hi-Fi were two companies that sort of said a fair bit about where the consumer has been and maybe where it's going.
Yeah, absolutely. I mean, I think there's, to me, I would say the CEOs generally have been mildly surprised at how well sales are holding up, and certainly how good last year was. And although, I think Anthony Scully, who's a great operator, Nick Scully, I think he was, sort of said, look, we've actually started the year very well. But we're cautious about where we head to.
And we spend a lot of our time being cautious about things that don't always materialise. But the thinking, of course, is that the consumer's been on a tear and has to pull back soon.
Absolutely.
And some companies it'll happen to, some it won't.
Well, I think that's one point I'd just quickly make is that there will be a lot of companies that will be unaffected by that, and there will be some that are affected by that. So that's probably...
It's really important to realise that, because the economy isn't the market.
Right.
And that's when we see the headlines that talking about stresses and all these kinds of things on businesses, consumers, rate rise impacts, etc. Some companies, even if they're exposed to that, benefit. So it's not always...
Well, that's where the money can run.
It can run.
Yeah.
Exactly. So we have to be careful of that. Let's get into some other results. Westfarmers is a classic one because it's largely consumer and trade facing.
Yes.
But it's got a really interesting element that I know you picked up.
Yes.
So it's growing side of its business.
This looks really interesting to me. I mean, Wesley's produced another stronger than expected result. Management was sort of understated. Bunnings, continues to perform well. Probably a bit reflective of the economy as well, where the sort of CEO said we're finding consumers are now focusing back on value. So Kmart's doing really well again. So is Target, Officeworks, the category killers where it's perceived you're getting the best price you can. But it's the lithium thing that, so Westfarmers bought a business called Kidman a couple of years ago, and it's really flown under the radar, I think, because, once it's gone into the mother company, there hasn't been a lot of talk from Westfarmers about it. Which is their style. But in the so we found out last week, second half of 2024, this mine will come online. Westfarmers owns 50%. A big Chilean lithium producer owns the other half. And if you look at the numbers, Westfarmers in 2024, this is on Macquarie's numbers, projected to earn about 4.2 billion in EBIT. In 2025, when you get a full year contribution, Macquarie believe they'll earn about 2.2 billion in EBIT from that one division. So, one other stock we've spoken about earlier in the year was Mineral Resources, and it
same story,
feels like it could be a bit similar.
And it's good for people who wonder whether they're invested in an area and they don't really know, because these conglomerate style companies do give you exposure. You don't have to necessarily take that single stock high risk exposure to a pure player in that lithium space.
That's right. But I think, and the other nice thing is you get a good solid yield. It's a great business leading into this coming online. Lithium prices have softened off quite markedly this year, I would say.
That's right.
After a roaring 2022.
But the conglomerate deals with that.
Yep.
Okay, good one on that one. Let's talk about banks at change of pace. CommBank's result was really pleasing. We've had quarterlies from the other banks, so we've got a bit of a read. The sector's in good health.
Yep.
And overall balance sheets are very strong.
Yep. And I think, you could look at the share price reaction and think there must have been something nasty in there. There's a couple of little things, but I just think it had run so hard into that result. Hit an all-time high a week ago. We know that banks generally make better margins in rising interest rate environments, which is why the money's been chasing them. And that was the little surprise in there, was that those net interest margins had topped out in October and had retreated a little bit. And when Matt Common was talking on the call after, what he spoke about was this hyper competition that they are seeing in the mortgage market, where as these Australians who are fixed in their these fixed rate mortgages, as they're rolling off, they're going back to the mortgage broker and saying, I need to find the best mortgage deal I can. And you can get 5 to 5.2s at the moment. Like Matt actually said that some banks he believes are writing loans under their cost of capital. So, which is kind of good news in some ways.
His idea of competition and mine are different.
Yeah, exactly.
Again, it's just.
But it was a great result.
Bank CEO is real, isn't it? So,
it is. Yeah.
No, great result. One really interesting one to watch here, and it touches on the property thematic that obviously a mortgage book does, but REA Group and Domain. This period of listings was dreadful for them. Forget price of properties and everything you read about that. They need to list properties.
That's right. Yeah. So they, they've always said, we just want a nice gradual pricing environment, and we've had it rip one way during COVID, and it's ripping the other way coming out of COVID. And I think the sense when you listen to these companies, that they are of the view that once this interest rate cycle peaks out, now is that 2, 3, 4 more rate rises? That's the $1 million question. The RBA doesn't even know.
At some stage, middle of end of the year, sort of.
We're getting close, and the market will start to re-rate these as we get very close.
And the volume will return.
And the volume will return.
Which will be good for them. And another great result from REA.
Well, REA grew its revenue, and you've got to remember what they were cycling against was one of the strongest property periods. That was a year ago. So to have done that was a great effort.
Yeah.
And it really sets them up for when the listings do really normalise again. You're going to see, because they've done some good things with price during this period. They haven't wasted a crisis, and you'll see that earnings line's going to run back.
Yeah. Now, look, one of the best results in one of our biggest companies was CSL, where Paul Perot, it was his final result. He's left that business in remarkable shape, man.
Yeah, he has. And there was a couple of highlights here. The big one was the plasma collections. Yep. We know that CSL's had huge issues collecting blood in America through COVID, for all the reasons I think everyone's well aware of now. And what we saw was that the plasma collections are now back above where they were before COVID. The costs of collecting that plasma have markedly fallen. So, 38% jump in plasma collection for the year. But the other thing, which I think, again, it gets under-talked about, is the R&D pipeline. And Paul Perot said, it is the best I've seen in this company's history.
And that sort of statement, because he's been there 17 years, I think. So that's a phenomenal statement.
Yeah. There's 2 blockbuster drugs coming through to market in the next 18 months. And there's 2 or 3 behind that, which are getting very close to final trial decisions and things, regulatory approvals that could be even bigger.
And this is the thing about a company like this. It's got optionality, and we've seen it evolve over time. It wasn't in plasma when it floated.
No.
And the board said VM became massive.
Yep.
Securus, the flu division.
Yep.
The next incarnations are coming. So it's exciting. So good how they
can get better. It feels a bit like a loaded spring to me, because I know the share price has just gone sideways for 2 years, and you can look at it. It does that often though.
Yeah. We know it's sideways and has its up times.
Yeah.
You get to know the nature of stock sometimes.
Yeah, definitely.
Goodman Group. Another upbeat, bang the table sort of preso.
9th profit upgrade in, I think it's 2.5 years now. They are defying the property downturn because the demand for industrial and logistics assets is just off the charts. And I mean, Greg Goodman again said, and he said this 6 months ago, I've never seen rental demand the way we are seeing it. 99% of their properties are occupied. He said we're getting inquiries about renting stuff that we're still 2 years away from completing. So that is helping offset the valuation weakness that's happening because of interest rates. Whereas in other property things, whether it's a Charter Hall or Dexus, there is still rental growth, but it's not enough
keeping pace.
Yeah, that's right. You've got 21% rental growth equipment at the moment across the world. So That was an impressive result. And again, it's another one that will come out of this downturn in much, went into it in good shape, but it's going to come out pretty good.
It did, yeah. The bionic ear manufacturer, Cochlear, showing with the non-electives and electives together, firing that business, that's going really well.
Really well. A non-market buyback, which is another thing we have seen quite a few companies announcing. Balance sheets in Australia are very strong and they're putting that money to use now. It's a bit of a sign of confidence, I think. Dividends have been very good during this reporting season so far as well. Yeah.
One we've updated in the tough times, and now it's got the nice turnaround. Challenger Group then.
Yeah.
So suddenly interest rates bring them back.
Yeah, right. So they've now cycled through this period of pain for them that came out of the Royal Commission, which caused chaos in our industry. And then COVID hit and rates went straight to zero and no one wanted to buy a term annuity, understandably. But now you can, lock in quite a decent return on lifetime annuities. They had their strongest 6 months in the company's history selling annuities. Stock still looks cheap. Yeah. This US hedge fund that bought Caledonia's 20% stake and has been building that on market ever since is, I think, breathing down their neck. So, it's definitely one that struggled in the lower rate environment and is doing much better in the higher rate environment.
Yeah. And just lastly, Deterra, which is a really simple business, benefiting from the royalty stream. Talking about some interesting things, maybe how they might expand their business.
Yeah, well, I think we've spoken about this coming a number of times, so we won't go right into it. But it gets this incredible royalty from BHP's biggest iron ore mine, which is 2/3 of their production and is growing rapidly. But it's banking a lot of cash. Well, it's sitting on quite a lot of cash, and what it's looking at doing is going to companies that are at the cusp of trying to work out how to fund their undeveloped resource. And because the market conditions have been tough lately, rather than doing big share placements or rights issues, how about we give you the money, but we take a royalty over that asset and you don't have to dilute your equity in doing that or potentially have to pay 9 or 10% to a bank to borrow the money. So, to me, it makes a lot of sense.
And shareholders are looking for that. They're seeing it as mature.
They are. You just want them to make sure they buy the right thing.
So that's something we'll be watching and informing everybody about. But that's all we've got time for. We'll have another update at the end of reporting season, but we better get back and listen to some results. Thank you.